Welcome to We Build Great Apartment Communities, the only show dedicated to the process and strategies for transforming apartment buildings to thriving communities. I am your host, John Brackett, and welcome to the show. All right, folks, welcome to another great episode of We Build Great Apartment Communities, the only place where you come to learn how to take apartment buildings and turn them into amazing communities. I'm your host, John Brackett. Welcome to the show. So today I have a bit of a treat for you. So someone who has been in this space for quite some time, from the Dallas market, been there for 20, I think maybe 30 years now, but kind of a unique show, right, today, because we're going to talk about someone who has invested as a passive investor, as an owner-operator, and then as a general partner in over 3,000 units. So the great thing about this show is Dallas is a very popular market, still is, right? Hot market right now, has been for probably the last 7 years or so. And today we get the unique opportunity to talk to someone that has been in that market for over 20 years, but has invested in this space from a couple different vantage points. And so we're going to be able to get her to share those vantage points today. So I'd like to introduce everybody, Sandhya Seshadri.
Thank you so much, John, for having me on your show. I'm glad to be here.
You're very welcome. So not only have you invested in over 3,000 apartment units, but you've been able to leverage your experience, right, as a electrical engineer. And I'm sure your MBA has also contributed to, right, some of that success outside of your dynamic personality, of course. So why don't you start by sharing your story? I think this will be a really good opportunity to introduce you to the audience, and we can kind of move through it.
So like most typical Indians, I went to school, made the best grades I could, got an education as an engineer, got a job, went to the corporate world, and pretty soon as an engineer doing technical work, realized that all the marketing types and business types are making all the decisions out there. So I wanted to figure out how they make those decisions. So my next step in my education was to get an MBA, and thankfully my company paid for that. So after that, I figured out this is how business decisions are made. This is how you do your analysis, accounting, finance, spreadsheets, right, all of that.
Right.
So once I got through that, all of that business background helped me also get into the stock market pretty heavily. So the stock market has been wonderful. No magic trick. I've just been, I guess, lucky and blessed that it did well. So I was able to go full-time into that and give up the corporate rat race. But then I started paying a lot more in taxes as I did well in the stock market. And that's when I was like, real estate makes a lot of sense. However, I wanted to avoid the 3 T's or the 4 T's, tenants, toilets, trash, and termites. And that's why I stayed away from,
I've never heard the 4 T's being termites added to that. That's so funny.
Pest control is a big issue. So tenants, toilets, trash, and termites was something I didn't want to deal with. So I didn't want to self-manage single family. But when I heard about multifamily and how you can hire a property management company to do all of that day-to-day work for you, and you can asset manage at a high level, that kind of made sense. And that's why I got into this multifamily space. So for me, it's a third career. I know you may hear about a lot of people in their 20s getting into this space, but, when I look at our current and past presidents and you see that most of the people in Congress, Senate, et cetera, are making major decisions well into their senior years, I feel like I still have a few decades remaining in my life to go about this third career venture. And that's why I'm here. So for anyone who thinks they're starting out a little bit late, I can assure you, look at the major decisions being made in this country. You're never too old to get started in real estate.
Yeah, I really appreciate you sharing that because I think that's a kind of a good viewpoint, right? Because oftentimes, whether you're young or you're a little bit more seasoned like you and I are, right? Oftentimes we tend to discredit ourselves for a lot of different reasons. Age being one of them, but I know folks in this space who are just out of college for a couple of years and they're doing really, really well. And of course, I know many people that, have just various types of experiences, right? And they've been in the corporate world for 10, 15, 20 years. They're out, pursuing, their own ventures inside of this space and they're doing extremely well. But what really stood out on what you said Sandhya, is decision, right? The ability to make decisions. So I find it interesting that, your comment was, hey, I want to learn how decisions are made.
Yep.
Because I recognize that the people out there either acquiring or managing assets, they're doing two things. They're selling and they're making decisions. They're making their presentations or they're selling based on, a criteria, right? Mm-hmm. And of course, that's usually some type of economic criteria. Mm-hmm. So talk a little bit about that, because I think that's a really, really great conversation to have, especially with our audience, because in business, I always say the most important skill you need to acquire is the ability to make a decision.
Yep.
Because doing nothing is not a decision, right? So talk a little bit about that.
So doing nothing is actually a decision. So if you're listening to this and you think real estate is cool, but you're not going to take any action on it, then you're making a choice, which is to not do something. So that's all. Doing nothing is actually an option. So if you do nothing and a year later you look back and say, what did I do the past year? Why didn't I get into real estate quicker? Then you've made that choice today by doing nothing. So keep that in mind. But decision making, especially by following the financials, is one of the best and most useful things you can learn in life. Whether it's a business venture, whether it's your own household, whether it's a career choice, whether you're advising your kid on where to go to college and what major to pick, follow the money trail. This is how much money I need to make a living. This is how much money that spells my financial freedom. This is what spells my time freedom. So I can sit on the beach all day and still get mailbox money as passive income. Whatever that number is, that's where your decision making starts. So if I want to make $10,000 a month, how am I going to get there? With my current job, or with my career choice for a kid going into college, or with this real estate, okay? So I looked at single family rentals as an example, and I felt that the margins I would make on a single family were in the range of $300-400 a month. But then I would have all the headaches of running that property, leasing it, and when a tenant leaves or doesn't choose to pay the rent in these days, then it's 100% loss of rent for me. That's why the economies of scale didn't make sense when it comes to a single family rental for me, because houses, especially in this area, haven't appreciated a huge amount until fairly recently, and I'm talking about Dallas, Texas. So again, the financials can help you really make good decisions, whether it's a company, right? So what are the assumptions behind your financials? That's how you make decisions in multifamily, because it's not just a matter of typing in the numbers from a broker's offering memorandum, putting it into a spreadsheet and saying, oh, this deal works. Well, of course, this deal works if you believe what the broker says in the offering memorandum. So you got to go dig inside that and see what the assumptions are. Are the rent comparables fair comparison? Are you comparing the C-class property to another C-class property within a 1 mile radius? Or are you comparing it to a nice brand new fancy A property and saying, oh, look, you can achieve a $150 rent bump? Is that a fair comparison? So financials and assumptions, if you understand those two, you can do all the decision making you want in life.
Okay, so let's talk a little bit about assumptions then in multifamily, right? Because we make assumptions every single day. But how we qualify those assumptions are extraordinarily important, right? Mm-hmm. So there are typically a couple of ways to group those assumptions. If we just look at an income statement, we can group them by revenue, we can group them by expenses, and then we can also group some of those assumptions maybe based on some type of exit criteria. So let's use a cap rate, right? Because those are usually the three most common. Mm-hmm. So when you are making assumptions, okay, and let's break this up two ways. When you're making assumptions as an operator, you're probably looking through a slightly different lens, right? If you were a general partner, then you might be if you were a limited partner, right? So let's talk about the assumption criteria that you use as a general partner. What does that look like? What are some of the key things that you look for when you're thinking through your assumptions?
The first thing is I'm in a market that I'm very familiar with, having lived here over 3 decades. Otherwise, I'm going to rely on someone who's local, very local, and really knows that market. And one of the basic things you look for is the crime stats, the crime data in that area. That's a quick screening criteria for me to make a go, no-go decision before I spend hours looking at a spreadsheet or any further analysis. The second one is median household income. does the median household income support the rent bump I am planning? Not just today's rent, but also plus another, $100 or $200 that I'm planning in the next 2 to 3 years as I take over this property. Is that realistic for that median household income in that area? Can they support it? Not average income, because again, speaking from a statistical standpoint, all it takes is for, one celebrity to move in there and your average is completely skewed. So the median household income is a very important criteria. The other one is look for population growth, right? And catch the tailwind of population, right? So everyone from the West Coast and East Coast, they're moving to certain specific geographic areas. So go to places that I call red states where they're a little more landlord friendly and where you're catching the tailwind of increasing economic growth, population growth, all your news reports data. There are certain great sources, CoStar, Yardi, all economic indicators are showing that you are going to see this increase in property value appreciation, etc. So pick such markets. The market is very crucial. For real estate, again, it's all about the location. So you got to pick the best location where the crime is good, like low crime data and median household income and market criteria to pick your property. Then beyond that, now you start looking at the assumptions for that deal itself.
Okay, so let's talk a little bit about median household income, right? Mm-hmm. So when you talk about median household income and making sure that there's enough income there to support your rent increases, right? Or at least the demographic can support those rent increases. Can you elaborate on how you make that assessment? Because you can't just look at median household income and say, okay, well, there's enough income here on a per household basis to support my projected rents, right? But how do you go through that process? What does that process look like for you?
If the average rent in your property is, let's say, $1,200, you want to have $45K to $50K plus in median household income. If the median household income is only $30,000 and you think about 1,200 times 12, which is 14,000 plus other expenses, that's too much for someone making only 30 or 35,000 as a household income. So you want to more be in a 3 to 4x kind of factor once you figure out the annual max rent that you're going to be charging. Plus, in some cases, they might still have to pay their utilities and other expenses. So you really want that number to fit well with the overall income that they make. So at $1,200 a month in average income, average rent, you want the household income to be at least 45 to 50K. 35K would be too low. So that's a simple example.
Yeah, actually that's really a good one because it kind of mimics what we would go through when we're actually requesting or having a prospective tenant complete an application, right?
Correct.
There's some commonalities there. So I think that's a great one. It's very simple. It kind of mimics what we go through when we're requesting when a tenant is completing an application. And that's a really, really good one. Simple, clean, and applicable, right?
So crime, good location, median household income. With those
what crime data sources do you use that you've had success with in the past, or that you use now for that matter?
There are several different websites that I just put in crime stats for Dallas, and then it pulls up several websites. That's all. It's on Google. So I don't remember the exact website that I always look for, but it's got this light blue, dark blue, et cetera, black kind of areas.
Is there a threshold? Is there a threshold that you won't go below, or what does that look like?
So I look at national average, right? And then I look at the state average. I want to be below that. So I try not to go above that in that area because I don't want to have to fight those battles. Now, some other people I know, they're very strong operators who can handle that. But sure. I, pick places that are not far from where I live. So I drive by during the day and at night. The daytime, again, used to be more valid a couple of years ago, pre-COVID, when you wanted to see how many cars are parked in the parking lot during the daytime just to see jobs and stuff like that.
Right.
But the nighttime, the scene really changes. If you've ever driven by an apartment during the day versus at night, you want to just see how safe do I feel around here? What kind of crowds does this apartment seem to attract? What's going on really at night in this area? If I want to be family friendly, I want to be located in a residential neighborhood, 3 doors down, 4 doors down from a school kind of place. And that's the kind of people I want to attract. So is it family friendly, right? Versus I'm in a more, suburban or urban kind of location. It's more the singles. My unit mix in my property matches that profile. So if I'm attracting more of the single with a new job kind of person, 1 bedrooms might be okay for the unit mix as, 2/3 of it. But if I'm more thinking of bias school families, especially a lot of them tend to have large families depending on the ethnicity in that apartment, you want to look at the square footage and the number of bedrooms. And you want to have predominantly 2 and 3 bedrooms maybe, right? So that's another thing to look for.
Okay, awesome. So I appreciate you sharing that. So now let's switch hats and let's approach the same question from the viewpoint of a passive investor, which you are and have been as well. So how does that criteria change for you, if at all?
So I still look at all of the basic location criteria, but the foremost thing is you're betting on the jockey. So who is my operator? Who is this deal sponsorship team? What experience do they have? What is their track record? So I would like to see a list of all the properties they currently own and manage, and how successful those individual properties have done in the past couple of years, especially through COVID in 2020. How are they addressing delinquencies? If today they're making an offer on a property, how have they fared in delinquency in the past at this property? How friendly are the local courts in terms of eviction laws and things like that? What is your insurance to collect rent? If people just squat and say, I'm not going to pay rent and you can't evict me, what are you going to do? So I want to hear their solution for that. So really a good sponsorship team can even take a not so great deal and make it work. And a bad sponsorship team can take a fantastic deal and run it to the ground and lose money on it. So the sponsorship team is always your number one criteria. If they don't have any prior experience and this is their first deal, for someone who's coming to you to raise money, you want to make sure there's someone in the team who has some experience. Sure. Because I know this is a strange analogy, but let's say you're undergoing brain surgery. Do you want to be the first one to be operated by this brand new surgeon? Or do you want to make sure there's an experienced surgeon also at least in the room, right there and available to take over if there's an emergency? So I kind of look at that when you think about these large investments of the realm of 50K and up for these passive investments. It's very important that you trust the team to cover all the bases. One person is not going to have all the skill set, but as long as the team has complementary skills and can cover all the bases and, address your concerns, then it's really good. So get a list of deals they have done in the past and ask for a reference of a passive investor from every one of those deals. Because there could be some good deals, there could be some not so good deals. So how did they overcome that problem? Like I see a lot of deals struggling in 2020 due to COVID. Well, what are they doing about it now? Well, some of them are saying, okay, I tried. This delinquency is a real problem. But guess what? Cap rates have compressed. Prices are going up like crazy. I'm just going to sell this property, return all of y'all's money, and you're going to make money in the deal regardless, just from appreciation, right?
So no, and I appreciate that. You said something that I thought was pretty interesting, and that was, when you're qualifying operators or general partners, one of the questions that you're asking about is how they've dealt with delinquency and just some of the operating issues that naturally came about last year because of COVID-19, right? So what has been the best answer to that question and the worst?
The best answer is usually, in some cases, a little exaggeration of the truth, but some others have been honest in saying, somehow we lucked out in that all our tenants are really good and they have paid, so we haven't suffered as much. And then the other ones are saying, yeah, it's a real problem. We've applied for this rent relief, but they're being honest about it. We really hope this Texas rent relief, the website was a pain to deal with, etc. We hope they pay us, right? And in both cases, those are honest answers. And that's what I look for, because you want transparency. You don't want them to spin a tale and find out later that it's not true. The worst answer is, I don't know what I'm going to do. That's the worst answer. It's like, okay, do you want some help? Hey, like I'm an operator. I can tell you, here are 10 resources you can go. So find your local helpers, right? Not just the Texas state for the relief. Go to local churches, local organizations, anywhere else that you could apply, your county, who are all the people who have some resources to help your residents who are unable to pay, put them on payment plans, etc. So the worst answer is, I didn't think of that. I don't know.
You know, one of the things that I always look for, really in almost any business venture where there are going to be partners involved, including my own, is how they've dealt with prior challenge, right? Mm-hmm. And asking a lot of questions about their ability to overcome challenge, because in almost every single venture that I've been involved in, things never go as planned, but it's how the partner or partners or team, how they're able to get to the finish line, right? Yep. And those are things that I look for. So I don't really start with all their successes, because I think, you know, sometimes it could be easy to concentrate on success when things are going great in a great market, but we just came through something very unexpected and we're still going through it now. And that's just a reality of life. And we're always going to run into some type of opportunity and some type of challenge for that matter, right? So I just love understanding how people think about challenge and, you know, what the last challenge was that they went through and how they dealt with it, right? And I've learned that usually the more they're able to clearly articulate through that challenge, it's just reflective of experience, right? Because you can't, no one's really smart enough to like provide extreme detail through problems. I mean, that just takes experience to be able to work through that, and consequently a little bit of wisdom. So with that being said, what's been the greatest challenge that you've been in on an investment, and how did you either work through that yourself, engage your team to work through it, or if you were a passive investor, you know, how did you engage the team around that challenge? Because I think, you know, understanding how people work through challenge is also kind of a good indication of how they are able to identify opportunity. So what was the biggest challenge that you've had to work through in an investment, and how did you turn that around, or how did you influence your team to turn that around?
So I'm what I call an active passive investor, in that I actually read my monthly reports, I look at the financials, and I ask a lot of questions. So when a deal started doing not so well, it was a distressed deal that they took over and hoping to turn it around, and then COVID hit. So month to month to month, I saw declines in the financials. I knew they were in trouble, and I gave them suggestions every month. And I said, why are you doing this? Stop doing this, et cetera, et cetera. And guess what? They didn't really take my suggestions. So back in July of 2020, they made a capital call. That was very bad. A capital call is where they don't have enough money to pay their debt service, and they go back to your passive investors for more money. And that's the worst kind of scenario you want to be in. Well, a lot of passive investors are truly passive in the sense they don't say anything, but I'm not one of those people, and I'm not afraid to rock the boat. So on a regular basis, I would look at their financials and kept the written communications going to where I was beginning to really irritate them, these sponsors. And so they decided to take some action. So I'm very pleased to say that they collectively decided that their best course of action is to list the property for sale, because the market has done really well. So at least we can get our principal back. I don't know if we'll get anything more back, but at least now, knowing how their delinquency situation is not improving despite their efforts, and they've had enough time to do something about it, I said, before it gets any worse, at least get me my principal back, or I'm going to have to raise a little bit of a ruckus on this.
Yeah. And where's that property? Where's that specific property? What market?
It's in Texas, and I don't want to give out too many more details because I want to protect these deal sponsors. They are now making an effort. They are listed it for sale, and I know it's going to go through, and the market has appreciated enough. So I think at least we'll get to a break-even point. But that's the case in my passive investment. Now, on the active side, one of the deals that I asset manage, one of the issues we ran into was a maintenance person who just wasn't getting through all the requests in a timely manner, was always tired and dejected and just didn't have a very positive attitude. And I would make a lot of personal visits, at least once a week, once every other week, etc. And the problem is when you don't have, your property manager and your maintenance folks, they are the face of your property. They reflect your management to all of your residents who are really your customers. So it's your customer service is poor. You don't take care of your residents. The maintenance requests are not being handled in a timely manner. They're not going to stay. So our retention is going to suffer from it. So that was not okay. So unfortunately, we gave him a chance for another month or so and nothing was improving and we had to let him go. But since we hired another maintenance person there to do the work, it's been fantastic. We are at 100% occupancy in that property. We have been the last 60 days and the next 60 days moving forward. We made a ridiculous 20% distribution to our investors and stuff. It's like this property is doing beyond my wildest expectations. We've done rent increases twice and everyone still seems to be staying and loves it. Our retention is high. So that's rare considering this COVID environment. But
Sure.
I really attribute that to our front property manager and our maintenance together working as a team to take care of our residents who are our customers.
And so how did you identify the fact that your maintenance person was contributing to your high turn rate, right? Did you come to that conclusion through just an interview process with the operations manager? Because it's really easy to see when, depending on your accounting system, your property management software, when your repair requests are not being addressed. But yeah. Sometimes it's not so easy to determine why, because the typical, the thing that usually happens when you're going through that process is there's usually a lot of finger pointing initially. But in talking through to you, I can see that you're likely pretty good at asking questions to get to the truth, right? So can you talk a little bit about that?
One of the KPIs we track, that's key performance indices that we track on a weekly basis besides all the financials, is the open work orders, because that's your measurement for customer service. Are you taking care of your residents? So we also not just look at the number of open work orders, but we also look at the types of work orders. So we know certain jobs are going to take much longer, or certain jobs are basically affecting quality of life of a tenant, right? Versus, okay, the paint is chipped here, or this handle is off a little bit, versus my sink is clogged. My toilet is clogged. My stove is not working, right? So which ones are affecting their lifestyle? My microwave door won't shut, so I can't use it, right? Things of that nature. We want those addressed immediately. So at least on a weekly basis, in our weekly calls with property management, we review the work orders. And if there are too many, right, like too many plumbing issues or anything else that's going to take a lot of time, we ask for extra personnel from a nearby property. And that's the advantage of having a third-party property management company who's also got another property nearby, is they can always call in extra people. So we pay for extra. Like let's say this week there's a lot of move-ins, or next week there's a lot of move-ins, and we have to do a lot of make-readies this week. Then we get a whole bunch of extra crew to come in and take care of that, so that our regular maintenance person can still keep servicing our existing customers.
Sure.
So you make sure you track the relevant things that'll promote retention. And retention is one of the most important things that sometimes newbies might tend to overlook, because when you retain your tenant, guess what? You don't have any days that your apartment is empty, like empty seats on a plane that's taken off. You'll never get that money back. So the turn cycle time could be a week, could be 2 weeks. When one tenant leaves and you have to get it prepared and ready for the next resident, you lose those days. You're not collecting rent those days, number one. Number two, the make-ready cost itself could be quite a bit, just to clean out the apartment, repaint it, maybe reface the cabinets, et cetera, right? Just a plain make-ready without upgrades still costs you time and money. And you save that every time that you're able to retain a tenant, even if it means giving them a discount or giving them a freebie. So you want to focus all your efforts on retaining the good tenants who pay their rents on time.
Yeah, I think that's really wise. What are the KPIs that you track? So you talked about one being open work orders, which I think is very clever. Mm-hmm. And what are your standard KPIs that you pay attention to?
So you always want to look at your financials, right? You want to make sure your collections are on track for whatever is your goal for that month. And so rent is due by the first of the month. So after the fourth, they are late. So you want to see how much you collected, especially in this COVID times, by the fourth or fifth of the month. And you want to start knocking doors at that time. So that's a very important KPI because a lot of people will pay late if they are allowed to. So you want to make sure collections are on time because if they pay late by the end of the month, then it's already time for the next month's rent. So collections by date, you want to track that. You want to have some automated daily report coming to you so that you're not always calling someone to look it up, or you should be able to log into the system to check that.
Yeah, exactly.
You really want to keep track of your expenses. You have some basic numbers on a monthly basis. This is how much I spend on, pest control, my repairs and maintenance, blah, 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 right? So anytime something spikes, you want to know why. Why is there a plumber's expense for $1,200? What happened there? Or why are we constantly having the same problem every month with the same apartment unit? Maybe we need to replace this instead of just doing repairs every time because the cost of replacement would go under capital expense. So it's below the line expense, below your NOI, right? But so then it doesn't affect your NOI. So NOI stands for net operating income. You definitely want to be tracking that. And that is basically your revenue minus your operating expenses equals your net operating income. So all of these three are very important metrics to track on a financial level. The other thing we track is what's called an availability report. It gives you an instant snapshot of what are my vacant units, how many days have they been vacant, are they pre-leased already, what is the progress right now, are they available? Or do they still have to be made ready or upgraded before they're available? So it's what we call the availability report. So
what software are you using, Sandhya?
I have different. Yeah, I've got different property management companies and each of them are in a different software. But for example, Resman is a popular one. So you can log into that system that's used by your PM company to track these things. But once you meet with them and do your initial onboarding process, there are certain reports that you automatically get sent to you as often as you want it. So during peak season, like I get the financials daily. I may ignore it for 2-3 days, but I know I can go back and see what happened if I want to. And I can log in any day and see what happened as well in the system. But I get some day reports as daily. I get some as weekly. So availability report at least weekly. And one of the things in the availability report that you want to look at is your renewals. We give our tenants a 60-day notice for renewals. So let's say that someone's lease is expiring in June. Then by April, they have a notice that tells them, hey, your rent is going to either stay the same or it's going to increase or what additional things we might be adding or changing to their leasing contract. And they come back and tell us, I'm going to stay or I'm going to leave. And if they've been a really good tenant and they've given a notice to vacate, which is NTV is how it's indicated, then I go back to my leasing manager and say, what can we do to incentivize this tenant to stay? Find out the story. Why are they moving? If they're buying their first house, yes, they're probably going to move. But if it's just because, something wasn't to their satisfaction, let's make it worth their while by giving them a discount or something, right? Let's give them, $100 off their first month if they renew with us. Whatever that takes. So it's very important to look at your availability report in detail so you can figure out these kinds of little stories behind those because it's much cheaper for me to give a tenant $100 off than work on making ready that unit again.
Yeah, absolutely. Absolutely.
Give them a free fan, hey, let's get you a new fridge, okay? Would you like a new stainless steel fridge instead of what you've got right now? Whatever it takes in that sense when you look at the cost. So besides your financials, your availability report, and your work orders.
Okay, great. Well,
then you want to look at your upgrades, whatever topics. Yeah. You have it.
I'm so sorry. I lost you. So what was it? You said you want to look at, what was the last piece? I lost you.
Besides your financials and your availability report, you want to be looking at your work orders. And beyond that, you want to look at your capital expenses. What are your current projects you're working on? Are you renovating units, interiors? Are you replacing any major equipment? Are you building a new leasing office or a playground? Are you doing private yards, etc.? What is the status of all your CapEx projects? Are they proceeding according to budget, etc.?
Yeah, I thank you for sharing that. So, we're in a unique market now, right? We've come out of one that was probably a little bit more unique in 2020, and now we're kind of moving through this market in 2021. So where do you see the opportunity going forward?
I think there's still tremendous opportunity in the apartment space in the right markets where population growth is happening, whether that is Phoenix, there's, of course, Dallas, Austin, Houston, parts of Texas, Atlanta, Florida, South of the Carolinas, et cetera. And Tennessee is emerging. There's probably a few other markets that I've missed. Idaho, Boise, Idaho, Salt Lake City even, although maybe a little less availability there. But all of these markets, the population growth is going up. The economy, there's more jobs, more manufacturing, and all kinds of other sectors as well.
Right.
So the demand for apartments is always going to be there. There's also lifestyle choices. As people age or there's more millennials, they want less responsibility in terms of taking care of a house. They'd rather leave it up to an apartment, just call a maintenance person to come fix something, than take care of stuff. So I think the demand for apartments is always going to be there. What you have to watch for is the trends within your little economic group that you're trying to attract. So if your resident is your family person who wants to live near a school versus, a single person getting their first job and wants all these amenities and a mixed use kind of place with the, package lockers, whether it's a class A property, which is your newest property with nice amenities, pool, resort style looking apartment complex versus a nice, reasonable, affordable, clean and tidy, but not as fancy apartment because of its proximity to a school or manufacturing jobs. You really need to understand who is your customer, which in this case is your resident or tenant, and cater all of your amenities to something they're willing to pay for and feel it's worth paying the extra for. Otherwise, don't do it.
Sure. So you have to know your market. You have to know the demographic. So, Sandhya, thank you so much for being on the show. We're approaching the end of the show now, but this has been a great conversation, and I really appreciated you coming on, and you shared some very unique perspectives, right? Because you shared not only the perspective as an operator, but also that of a passive investor. And I think you did a great job of sharing with our audience the different lenses through which you assess both. And I think that was great. You talked also about KPIs and the importance of understanding your KPIs to be able to better use that information to make decisions against, which I think is great. And also the importance of making a decision, right?
Yep.
We have to make decisions. Mm-hmm. And you made the comment that which I really like, doing nothing in your term is a decision because you've made a choice to stay idle and not do anything at all, right?
Yeah.
So I really appreciate that. I've always said doing nothing is not a decision, but never really looked at it from your viewpoint. And so I like that. Doing nothing is a decision. You just have to accept the reality that you made a decision not to do something, and that's the outcome. Nothing, right? So thank you for being on. You've been a tremendous guest. Really grateful to have you on. What is the best way for our audience to find you?
The best way to find me is my website, which is multifamily4u.com, where it's multifamily, the number 4, YOU.com. And they can put in their name and email address if they want to get my checklist to vet a sponsorship team. I've got a long checklist of 11 mistakes to avoid when you choose a sponsorship team that I can share with anyone. And no, it does not add them to my email database or anything like that unless they want to keep receiving messages from me. So they are safe. They're not going to get spammed. And they can look at my checklist and use that checklist if they're considering investing with anyone or partnering with someone to ask these basic questions.
Yeah, thank you so much. Before we leave, what is the one question that you have of me that you think can add some value to our audience, if any?
What do you think is the best asset class to invest in real estate in the next year? Is it apartments? Is it something else?
That's a great question. I mean, I own a mix of properties or asset classes. I call them product. I own a bunch of different types of real estate product. So I own everything from single family homes to apartment buildings to commercial land for that matter, commercial properties. So my appetite has kind of shifted over the years. However, I still like apartment buildings, and I also like, for the next, I would say, because I think right now we're in an inflationary market, right? So owning real assets is a very good thing. And, whether it's precious metals or real estate, as long as it's real and it's tangible, I think you're going to be able to hedge yourself against inflation. But one of the things that I've learned over the years is single family homes, when you're in a market, especially like this is a really good example, right? You have low interest rates, supplies relatively constricted. And so the natural byproduct is you have a lot of money chasing fewer goods. And I think that's going to continue. And so some of the things that I'm looking at right now are actually building in some markets where you have building small subdivisions or even participating in larger subdivisions for that matter, where you have, to your point, influx of people, right? Where you have a shift in population going into that market. And I think there are going to be some really unique opportunities there over the next 10 years. We're going to go through another 10-year cycle. I think right now we're in year one of that 10-year cycle. And so understanding that, I think that's a really unique opportunity. The other asset class that I really like right now is the same concept, but holding those properties, right? These larger subdivisions that are being built out to hold. I really like that product a lot. I spent a lot of time over the last probably 14 months researching that and reaching out to people trying to understand that product a little bit more and who are the big players in that marketplace. I think that's going to be a very unique opportunity going forward for a couple different reasons. One, for what I mentioned, right? You can always sell off to a retail buyer. A retail buyer is always going to pay more than an investor. So that's something that I really like as well. The other side of that too is you can also capture the retirement market, which is growing and going to continue to grow over the next probably 10 years as well. So I really like that. And of course, apartment buildings I like. I think industrial properties are going to have, I think industrial product is going to continue to be in demand because of how we shifted right now in our markets, right? You have more people that have been forced to go online. And so that trend has been accelerated. And consequently, I think distribution is going to continue to be big and continue to grow. And so one of the things that I'm doing is looking for market areas to buy apartment buildings, but where those markets, for example, Sandhya, where they're very big distribution markets. Mm-hmm. Right? They're very big distribution markets, really to capture the play off of distribution, because I feel the incomes are going to be higher. And of course, you're going to have the opportunity to capture higher rents using your analogy of median household income. I really like markets where their distribution channels are growing, whether it's rail, whether it's ship, or whether it's truck or plane. Ideally, rail, ship, and truck. If they don't have any shipping, then rail and truck, right? I really like markets like that. So anyways, the summary is those would be my three.
Awesome.
Yeah.
That sounds like some great investment choices for everyone. So include multifamily in the mix, apart from other things, but be very, very careful in vetting your sponsor and your deal, because one thing about real estate is that it's not liquid. So you don't have your money for a few years. It's not like keeping it in the bank or in stocks that you can cash out immediately. So definitely plan for 6 months of living expenses before you invest in real estate, because the money could be tied up 3 to 5 years or longer. And really understand that when they say they might sell the property in 5 years, maybe it's 5.5 years, right? So keep that in mind when you put your money in real estate investments.
Okay, awesome. Well, I want to thank you again for being on. You've been a tremendous guest. I want to wish you continued success and abundance, of course. And I will talk to you hopefully soon.
Awesome. Thank you so much for having me on your show, John.
Yeah, thank you. You've been tremendous. Thank you. Clarity of purpose creates our greatest competitive advantage. When we transform apartment buildings to thriving communities, we improve how people live and create assets with high profit margins. Don't forget to subscribe, like, and share this up with a friend. I'm John Brackett, bringing you things you can implement right away.